Fed's September decision to maintain rates mean that interest rates are going to stay high for a longer period of time. The Fed decision was to leave interest rate unchanged at 5.25 to 5.50 until their next meeting in early November. The Fed is still very focused on bringing inflation back down to 2% and have mentioned that they will proceed very carefully as to what comes next. In this higher for longer environment, investors looking for yield and safety may continue to find attractive opportunities in the front end of the curve. We continue to say and believe that investors should not fight the Fed and that investment grade rate floating rate notes are very attractive due to their enhanced yield and safety. The lack of interest rate sensitivity is a positive contributor when rates move up for floating rate notes. And this is because floating rate notes offer a coupon that is equal to a spread over a reference rate, and that coupon resets with whatever the prevailing rate is at that time, so their prices don't need to adjust. The end result is a very stable price for floating rate notes. This is very different to what happens to fixed coupon bonds. Fixed coupon bonds see their price decline when rates move up and their price increase when rates move down. Because of their non-existent sensitivity to changes in interest rates, investment grade rate floating notes have strongly outperformed most fixed income over the past 2 years, and they're currently providing a higher yield than T-bills and floating rate notes issued by the US Treasury. The outlook for the coming months is high interest rates will continue to bring inflation down, but it will also slow economic growth and potentially have a negative impact on riskier borrowers. Default rates have already started rising, and the market expectations are for a continued increase that's going to be driven by the lingering repercussions of rising interest rates. For investors looking for higher yield, ultra-short exposure, we believe on two options. One of them being CLOs, as they provide greater spreads with built-in risk protections, and the other one being investment-grade floating rate notes, as they are a more conservative option that provide exposure to a completely different set of issuers. VanEck offered the VanEck IG Floating Rate ETF, ticker FLTR, which offers exposure to investment-grade corporate bonds, offering near zero duration with enhanced yield potential. To learn more, visit vaneck.com/FLTR.